We hope to provide the tools for more critical reflection in our contentious debate, Should we worry about future inequality, with Chris Snowdon and Stuart Lansley, to be chaired by Dr Margot Salomon.
Thank you very much. It's great to be here. Good to see this conference happening. It feels in a way quite strange to go first on this, because I'm sort of having to go against an argument that hasn't yet been made, but I suppose in a way it reflects the presumption that a lot of people have that we should be very concerned about inequality. We should be worried about it. It's also strange to be talking about what's going to happen with future inequality. We obviously don't know what's going to happen with inequality in the future. Might go up, might go down. I can simplify that by saying I think that I'm not worried about inequality at the moment, and depending on the reasons for why inequality changes in the future, I see no particular reason to be very concerned about it in the years ahead. We need to quickly define our terms. We're not here, I'm sure, talking about inequality before the law or political inequality. We are, I imagine, talking about income inequality and perhaps wealth inequality. My position really on this is quite straightforward, I think, which is that income inequality, wealth inequality, these things are merely economic indicators. They cannot in themselves be the cause of anything. However, they do reflect things. They are the result of other things happening in the economy. Sometimes those things might be good, sometimes they might be bad, but it is the root causes of the inequality that we should be looking at, and we should be judging on their own terms whether these are positive or negatives. Now, over the course of the next few years, depending on what happens with inequality, I can imagine being concerned about it if, for example, it looks like it is rising exponentially and we're going to very soon come to a point where one person has everything and everybody else has nothing. That, I think, clearly would be a problem, although it would surely reflect major structural problems within the economy that's leading to that position. I would be concerned about inequality if people were poor because the rich were rich. I would be concerned if we had rising inequality but stagnant incomes. I would be concerned if we had a stagnant economy, no economic growth, and the rich, therefore, could only get richer by taking a chunk of the pie from the poor. I think all of that would be very bad news. I would also be concerned if we have rising inequality in the future as a result of cronyism, as a result of monopoly, as a result of markets not working properly, as a result of the government in some way hindering the poor, hindering social mobility. All these kind of underlying problems, I think, should be seen as such and should be dealt with as such, regardless of whether inequality is going up, going down, or staying the same. Whether inequality actually will go up, I don't know. It wouldn't surprise me if it ticks up a little bit over the next few years if the economy really starts getting going and if median incomes start to jump up. The reason inequality has fallen over the last 6 or 7 years is precisely because the economy has stagnated, because median incomes have fallen, and because people on benefits tend to be cushioned from the kind of declines seen amongst the rich and the median earners. You tend to see inequality fall. It's actually been the richest quintile that have seen the biggest drop in incomes over the course of the Great Recession. Now, that to me is not a good reason for inequality falling. Similarly, if median incomes start rising again, if the economy starts booming again and inequality rises, that would be a good reason for inequality to be rising. But the inequality itself is at best a side issue, and I suspect actually entirely irrelevant to it. The reality has been, and I'm not talking only about Britain here, is that there has been no rise in inequality as it is normally measured since 1990. There was a significant rise between 1984 and 1990 for a variety of reasons I don't have time to go into it just at the moment, but perhaps we can come to later. Since then, it has been, well, slightly below the 1990 peak. It wavers here or there, but it has been basically flat for 25 years. It's not immediately obvious why there has been so much concern about it over the last few years when you look at the rate in Britain, at least. It's a different story in places like America, but in Britain we have seen no increase in inequality, but we have seen major increases in incomes. Since the late 70s, we've seen incomes double on average, more than double for the rich, and somewhat less than double, about 80% rise for the poorest quintile. But nevertheless, no matter which section of the earnings distribution you look at, we have seen significant rises in people's real incomes, and I would expect them that to continue if and when the economy starts to boom again, regardless of the rate of inequality. And we also have significant redistribution, which I think makes it unlikely that we would see the South American style levels of income inequality in the first place. People's incomes before tax, if you compare the top quintile to the bottom quintile, before you have tax and benefits, it's a ratio of 15 to 1. It's a very large ratio. Unsurprisingly, if you consider that, in fact, most of the income of the bottom quintile comes from benefits. But after you have taxes and benefits, that narrows down to 4 to 1, which is exactly the same level as it was 25 years ago. So we're not seeing this exponential rise in inequality. And I would argue that it's actually a distraction to look at income inequality when we should be looking at wages, incomes, growth, jobs, all the things that are more difficult to deal with than inequality. The reality is, dealing with inequality, if you want to reduce inequality, it's actually quite easy to do. You just need to export your rich, as we did in the 1970s. Governments are fully able to reduce income inequality. The trouble is, doing so often has negative consequences. It's much more difficult to create prosperity, create jobs, but they are the things that we should be dealing with, rather than worrying about this gap, which is not really moving anyway, hasn't done for a generation, between the rich and the poor.
Okay. Thank you for sticking to time. Please, the opposition.
The slides.
You have slides?
Yes, I have some slides.
Okay.
How do I?
Okay.
Oh yes. Okay. Fine. So which one does that moves it on? Does it? Okay. Okay. Well. Thank you very much for inviting me, and we haven't got very long, so I'm going to sort of rush through these slides rather quickly. So. I just first of all I want to start with the basic evidence over the last 30, 40, 50 years. This is what is known as the inequality U-curve, which looks at the share of GDP going to the top 1%. And you can see that from the pre-war period right down to the 1970s, it fell very sharply, and since then it's risen again. So we're nearly back to where we were in terms of the top. This is one way of measuring inequality. There are lots of other ways, but this is one measure. So on this measure, inequality has got substantially worse over the last 30 years. If we want to compare Britain's position with other rich nations, these are OECD data. I haven't put every country in here, but you can see that Britain, on a very simple measure, the Gini coefficient, is towards the top of the international league table when it comes to rich countries. In terms of the future, this is a forecast by the OECD, which basically says that inequality on current trends is going to get quite a lot worse over the next 30 years. Now, does this matter? Does it matter that the top 1% have been grabbing a bigger share of the cake, that we are quite high up the international league table for inequality, and the evidence is it's probably going to get worse? Well, the orthodoxy of the last 30 years is it doesn't matter. The inequality is good for the economy. I've just put a couple of quotes in here. The argument that essentially that you need inequality to drive economic growth. You need to give much higher incentives to people at the top, to entrepreneurship. They will drive power, a bigger cake, and everybody will be better off. And there's this famous quote from Robert Lucas, the Nobel Prize-winning market economist, who's probably as much as responsible as many economists for the market economies that have been operated in the UK and the US over the last 30 years. He's made this famous phrase that the most poisonous argument in economics is about the question of distribution. And of course, part of this argument that inequality is good for the economy is the trickle-down theory, that you let the rich get richer, they create a much bigger cake and everybody is better off through trickle down. So is this true? Essentially what we've had is a real-life experiment over the last 30 or 40 years in which economy has been run at a much higher level of inequality. And I think the evidence from that experiment is that the basic orthodoxy that everybody's going to be better off through inequality is basically wrong. I think the evidence is, this is all very short, I haven't got time to develop these arguments, but the rise in inequality over the last 30 years has also led to a rise in inequality. If I just show you this graph here, which looks at the average income of the poorest fifth in the United Kingdom, I've given the UK a ratio of 1, compared with other rich nations, and you can see that in all these other countries, the poorest group in those countries is quite a bit better off than those in the United Kingdom, even though they're roughly comparable levels of wealth. And the main reason why these trends matter is because we've had, over time, if you take these long periods of time, we've had these big changes in the share of the cake going to different groups. So the 1% have been grabbing quite a bigger share. The next fifth have been grabbing a slightly bigger share, not quite as much as the top. And the bottom, this is over a long period, this is since 1979. If you did this graph over the last 30 to sort of 15 years, it would look slightly different. And this means that the poorest group in society, the bottom fifth, have been having to cope with a smaller share of the cake. Now, what's been driving these trends? These trends towards where the 1% have been getting a bigger share of the cake and the poor have been getting a smaller share. The main driver has been what's been happening in the labour market. Lots of things have been affecting the labour market, but essentially the jobs and pay market in Britain is much more fragile today than it was 30 years ago. There are a number of aspects to this, but what's been driving it has been a big shift in the share of the cake going from wages to profit. So the wage share, this is a graph looking at the wage share since the war. It was pretty steady in the 1950s and 60s at a relatively historic high, but it's been falling quite sharply since the late 1970s. On top of that, there's been an increase in the earnings gap, so the top earners have been increasing their earnings at a much faster rate than those in the middle and a much faster rate than those at the bottom. This relationship, by the way, between profits and wages and the way in which capital has been grabbing a bigger share, leaving less for wage earners, has been described as a dangerous gap by the head of the International Labour Organization. But the main effect of these shifts is that Britain has become a low-paid economy. We are now second in the world league table in terms of the proportion of the population are low-paid. If you did this graph for the mid-1970s, it would have been 12%. So 12% of British workers would have been low-paid on the standard definition. So there's been almost a doubling in the proportion who are low-paid. Now, the second reason, there are three reasons why inequality is bad. The first is it increases poverty. The second is the evidence, I think, is becoming much more accepted that inequality is a drag on growth. Over the last 30 years, inequality has been associated with lower levels of growth. There have been lots of studies on this. I've just given you quotes here from the IMF and the OECD that says that we can debate why this is when we have a little bit more time during the discussion. But I think one of the key reasons why inequality, as driven by an increasing profit share, has been a drag on growth is this graph here. This shows, since the war, the relationship between the profit share and the level of private investment. The level of private investment is the fundamental driver of economic growth. And you can see that's what's happened since the mid-1970s, that the profit share has been rising and the level of private investment is falling. And one of the big issues about the macroeconomy and what's been happening in the economy is what's been happening to that money, what's been happening to that gap. And the third reason why I think inequality is bad economics is that it makes economies much more prone to crisis. And the reason it makes economies much more prone to crisis is that it shrinks demand. Inequality reduces the level of consumer demand in the economy quite substantially, and that means that the economy becomes dependent on other factors. And those factors have tended to be artificial stimulants, rising personal debt, printing money, QE, and so on. And all these are essentially unsustainable. You cannot keep running economies using these artificial stimulants. Eventually, they will implode. In this sense, inequality-driven economies are essentially self-destructive. Okay, so I'll end there, but just say that if we'd had this debate 5 years ago, I think the things that I've been saying would have been very controversial. Now, they're being much more widely accepted. And I've just given you a few quotes, which I'm sure you're familiar with, all of which are basically saying inequality is a major problem, and we really ought to try and cap it and reduce it. Okay, thank you.
Great, excellent start. Can we turn to Chris? Inequality is self-destructive, or are we chasing the wrong problem? What would you come back with regards to the facts, figures, and position that's been taken by Stuart? Let's give you about 5 minutes if you want.
Oh, really? Another 5 minutes? Okay.
Well, or less, we can go back and forth.
I'll just come back to some of the things Stuart said, if I may. On the rates of inequality over the last 25 years, I think we need to clear this up for a start. I said that it had been flat. Stuart's shown you a graph showing it's been rising. He mentions that there are other measures of inequality. Well, there are every other measure of inequality, apart from looking at the top 1%, shows it's been flat. Compare the 90th percentile, 10th percentile, 80th to the 20th. The Gini coefficient, which he showed in his other graphs, is the standard measure, and under the Gini coefficient, it's been flat for 25 years. Now, I don't want to get bogged down in this because, as I say, I don't really care whether it goes up or down. But just as a matter of fact, you haven't got this, this rise in inequality under anything other than the top 1%. And I think that's interesting in itself. And I think it requires some explanation, because I think it actually does explain part of the reason why this has become such a big issue over the last few years. Stuart said, I think, if I'm not misquoting him, he said that the top 1% has been grabbing a bigger share of the cake, which is true. He also says, as the poor have been getting a smaller share. Well, that's actually not true, and I didn't realise we could bring slides, otherwise I would have a nice little slide to show you here, which actually breaks this down in ways that I think are more easy to understand than simply looking at a single number under the Gini coefficient. And that is, what slice of the cake is each decile actually receiving, and has been receiving over the course of the last 30 years. If you look at the bottom decile, the poorest 10% in terms of income, they've been getting 3% of national income since 1990. Neither has it changed. The top 10% have been getting about 26. It has wavered a point or two here or there, but it's 26. I think it was 28 in 1990. It's 26 now. Basically, it's always been the same. And in fact, every other decile basically is the same, possibly 1 percentage point either way, but more or less rounding errors. Every part of the income distribution is essentially being getting the same share of the cake. Now, let's not forget, that cake has got a lot bigger. It's always a bit dangerous to start talking about grabbing slices of the cake. The cake is not a fixed size. It has been growing a lot since 1990, so 3% now is a lot more than it was in 1990. But my point is that even if you look at it as a fixed cake and people are grabbing bits of it rather than actually earning money, that hasn't changed. And yet we do know, as Stuart's quite right to point this out, we do know that top 1% has been grabbing more. So if they've been grabbing it from somebody, who they've been grabbing it from? It's not from the other deciles. It's not from the bottom 90% of the income distribution. It's from the rest of the top 10%. Now, I think that actually explains quite a lot. I think inequality within the top 10% has been quite stark and has been rising over the last 25 years. But it has not come at the expense of the people in the bottom 10%, or indeed in the bottom 90%. It has come at the expense, if you want to put it in those terms, which are wrong, but to keep things simple, if you're looking at one man's gain is another man's loss, it's been coming at the expense of the other people in the top 10%. In other words, of the rich, of people who are globally are the 1%. Now, I think, and this is only a theory, because I don't see how you would ever find evidence to back it up, but I think it is quite plausible that when you're looking at the people who write the most and talk about inequality, we're generally talking about people who are actually already in that top 10%. We're talking about people who are senior broadcasters, newspaper editors, professional academics, and so on. And I suspect that what we're seeing are people who consider themselves to be the sort of natural aristocracy, who have always been part of that top 10%, have felt themselves outpaced by vulgar sportsmen, pop stars, hedge fund managers, bankers, the nouveau riche. Undoubtedly, the likes of Wayne Rooney have gone into a different level entirely compared to the bank managers, the senior academics of old. So, within that top 10%, there's certainly been an increase in inequality. I don't personally think that we should be very concerned about how much the gap is widening between the 99th percentile and 99.6th percentile. I don't think that's an issue for the rest of us, the 90% or even the 99%. And as I said, I can only put that forward as a possibility. But the only area in which there has been a stark difference has been at this very top end, partly as a result of globalization, partly as a result of technology and so on. But your Premiership football players, your hedge fund managers are undoubtedly earning vastly more than similar people would have done even 25 years ago, let alone 50 years ago. That's where the difference is. But I don't personally, as somebody who's in the bottom 90%, as I'm sure nearly all of you are, I don't see how that is a great concern to me.
Okay, I imagine, Stuart, that you would like to come back on a few points.
Yes, I mean, I certainly agree with Chris that if we look at the broad range of the income distribution, from the 90%, the bottom 90 or 95%, then that hasn't changed much over the last 15 to 20 years, although it did jump in the 80s. So there was a big jump in the 80s. So the level of inequality, even on that basis, is higher than it was in the 50s and 60s. And that's mainly because professional salaries have leapt much faster than other salaries. That's the main reason. So there has been a leap. But I agree with Chris. I don't think this issue was really about the gap between, say, a bus driver and a brain surgeon. I mean, I don't think most of us think most of us probably think it's okay for a brain surgeon to earn 10 times as much as a bus driver or whatever. I mean, that's not what this debate is about. This debate really is about, and here I agree with Chris, is what's been happening at the top. And also, I think these figures that Chris was talking about, and I do actually, for various reasons to do with the way they're calculated, they come from survey data, do understate the real level of inequality. They understate the level of poverty, and they understate the numbers on low incomes, and they understate the number of high incomes. So the picture's actually slightly worse than the data. But I think that the big issue here, I think, is whether the mechanisms that enable the top 1% to have accumulated these great fortunes over the 30 or 40 years are mechanisms which grow the cake, that make the economy more efficient and make us more better off, or whether they are essentially devices to extract a higher share of the cake for themselves at the expense of other people. And I think the evidence is that although of course there is a lot of entrepreneurship in Britain, and people are getting rich through entrepreneurship, through creating jobs and creating products which create jobs and make everybody better off, an increasing proportion of the economic activity that makes people very, very rich is not about entrepreneurship. It's not about job creation. It's not about new products. It's about manipulating the finances of existing companies in order to make themselves rich at the expense of employers, customers, and the taxpayer. Privatisation. Most of the gains from privatisation have gone to a small financial elite. If we look at all the mis-selling scandals of the last 30 years, and they're still going on, the mis-selling of pensions, the mis-selling of savings products, have been devices to extract money from essentially mostly the middle classes to benefit the executives who runs those schemes. There are so many devices: mergers and acquisition activity, private equity activity, share buybacks. There are all sorts of devices that are used by big companies, which essentially enable them to grab wealth, existing wealth, rather than increase the amount of wealth. And that comes very much at the expense of employees and lower income groups in society. So I do, but at the same time, these activities would be good if they were boosting the economic and productive strength of the economy, but they don't. I mean, the evidence is very clear that the incentive structure we've created in finance and in the corporate sector means that executives and financiers can make big money without building the productive base of the economy. Why would they bother? Why would they bother to go for sort of high levels of investment, the returns of which only accrue in 10 years' time, when they can make a killing within a couple of years by engaging in financial engineering? So I think this is very bad news for the economy, that the way we have structured the economy and the incentives that are available are actually reducing productivity and not extracting the potential that there could otherwise be. So I think the power that this top 1%, actually it's smaller than the top 1%. And it's not necessarily just corporate executives. I mean, there's a whole little army of, in the trade they're known as marriage brokers. The financiers, the lawyers, the city workers who manage all these deals, arrange all these deals, most of it in their own interest and their client's interest, rather than the interest of the future of the economy.
Okay, I'm almost ready to open the floor for Q&A, unless you want a minute rebuttal and then a minute rebuttal.
Could we? Quickly, yeah. Because I think now we're getting down to it. I think if we've got a complaint about different parts of the economy, and God knows we all have, spit it out. Let's address those issues and decide whether they are worth tackling on their own terms without bringing inequality into it. So if we've got a problem with privatisation, if we think nationalisation would be better for consumers, let's address that. The fact that it might have somehow affected inequality, I don't think is the point. I think the point is, privatisation, good or bad, for the consumer. Never mind who's getting rich off it, but is it a good thing? Share buybacks, are they a good thing? All these kind of things, mergers and acquisitions. Let's talk about these things. I fully accept that some people get rich as a result of government favours and privileges. I think that's wrong on its own terms. I think that people could get rich from government privileges when inequality is going down. I think that you could reduce inequality without having any effect on the kind of problems that Stuart believes he's identified. Inequality is a red herring. We can reduce inequality by deterring rich people from moving here, by closing down the premiership and all sorts of other things. It's not going to have any effect on the core problems that people are actually concerned about. And poverty is a big one. But often when people talk about inequality, you drill down. They're nearly always talking about poverty, actually. Fine, let's address that. You think that benefits are too low for people who are out of work? Let's discuss that. Let's discuss how much we can afford, how much we'd have to give them before there's a significant disincentive to work, all the other things. It doesn't change it doesn't change the old arguments. This is not in any way sort of radical new politics. It's just rehashing the old arguments, but with this sort of umbrella of inequality, as if that's the be-all and end-all. It's not the be-all and end-all. Many of the core problems that people are really trying to express when they're talking about inequality are perfectly valid, but we should talk about that rather than talk about inequality, because not only is it distraction, but actually policies aimed purely at reducing inequality will not in any way alleviate the problems that people are really concerned about.
Stuart, you have a minute to come back before we open the floor?
I think these problems that Chris has just mentioned, to do with poverty and opportunity, and the state of the economy, the level of productivity, the things that ultimately drive a bigger cake, are not independent of the gaps. They are crucially related. Not all of them, But I think that there is a crucial relationship between what is happening at the top in business and in finance and what is happening at the bottom and what is happening to the state of the economy. And therefore you cannot solve these problems of a weak economy, of a low productivity, low rates of innovation, and low pay without addressing the incentives, the nature of business generation, and the sources of rewards at the top. I think they are crucially related. Not 100%, but I think lots of them are related. They're simply not totally independent.
Excellent start. I imagine there's questions and good probing questions. Tough questions are welcome. Let's take a few of them. Who wants to be brave enough to start? Can I see a show of hands? We have a roving mic. Yes, please, in the front. It'd be a good idea to take 2 or 3 at a time, but let's see who else comes up next. Please go ahead, introduce yourself if you will.
Hi, my name is Andre. I just have a question. What do you think about the argument that the sluggish recovery from 2008, the lower growth in incomes, and alternative monetary policy like QE actually increased inequality, or whether it had any long-term effect on it?
Okay, QE and the increasing inequality. Who's next?
Should we just answer that one while people think of the question?
Sure.
Well, I mean, the recession in general had a positive effect on inequality, if you think that inequality is a problem. And this is always the way. Inequality fell relatively sharply in the early 90s for the same reason. There was a decline in real median incomes, I think, from 91 to 96. So this rise in inequality in the 80s, it wasn't reversed by any means, but it came to a stop and then fell in the 1970s, which some people seem to look back on as some kind of golden age because inequality was low. Exactly the same reason. Inequality is inversely related to growth in that sense. Every time the economy slows down, inequality falls. Now, one reason for that, and I think it's important to appreciate this, is that one of the things Margaret Thatcher did in the early 1980s is she tied benefits to inflation, whereas before they'd been tied to wages. Now, that had effect twofold. One, it meant that when the economy was growing, wages were going up at a decent rate. It meant that inequality rose, right? Because your bottom 20%, most of their income comes from benefits. But it also means that when you have a recession and real incomes are falling, the poor have a cushion. And if you look at the latest figures from the Office of National Statistics, you see quite clearly it's the richest 20% saw their incomes fall the most since 2007. And the poorest quintile, believe it or not, saw their incomes rise. And that's because of the benefit system. Now, it's a two-edged sword. It means that if you had 20 years of unconstrained growth like Australia has, then the gap between rich and poor would grow and grow and grow. And I think that is something worth considering in the future. Let's, fingers crossed, let's assume the next century sees something like the same kind of economic growth as the previous 100 years. At some point, assuming that you have at any given time a significant and growing number of people who are dependent on benefits, be they pensions or out-of-work benefit or disability living allowance, it seems to me that you cannot tag that to median incomes, because within 50 years of decent growth, there is really no incentive to work anymore, right? I mean, they are on a significant amount of money. This hasn't happened yet, don't get me wrong, but it could conceivably happen in the future if incomes rise. So it seems more logical to me to do what we already do, which is tie it to inflation, maybe inflation plus a little bit, as the pensioners get, for example. But the big picture is that if you have growth, if you have rising incomes, and assuming you're not going to tie benefits to wages, then I think you can probably expect inequality to grow.
Stuart.
Well, I don't entirely agree with that. I mean, I think if you look at the post-war period, you can divide it roughly into two. You know, there's a two post-war decade. There's the period up to the mid-late 1970s and the period after that. And we had higher growth rates in the 1950s and 60s than we have since then. The average growth rate in Britain was about 3.5% between 1945 and 1979. Since then, it's been about 2%. You know, the first period, you know, significant growth was actually associated with greater equality. Since then, we've had slower growth, which has been associated with rising inequality, though, except for if you take out the last 15 years, where it's been slightly more steady, except at the top. So I'm not sure that it always follows like that. I mean, what's happened in the recession is that the immediate effect of the recession is it sort of protected the bottom. The bottom fifth were relatively well protected, you know, for the reason Chris said, because they were largely much more dependent on benefits, and benefits weren't cut, whereas asset values fell. So people who hold lots of shares or property, their incomes fell. So if you look at, there was a closing of the gap in 2009, 2010, 2011. There was a temporary fall. There was a temporary protection of the bottom and a temporary fall in the value of assets. That started to reverse again. The incomes at the bottom, we haven't got the most up-to-date data. The most up-to-date data is still about 2 years old, so we haven't picked up the impact. But I think the evidence is now is that gap is beginning to widen again. I mean, I've got one of the graphs I didn't use, but if you chart executive pay, top executive pay since 2000 against median pay, it goes basically, it goes like that. Executive pay goes like that to 2008, then it dips, and then it's gone back up again. Whereas the median income goes sort of like that and flat. So the gap between the top and the median has been growing again quite substantially over the last couple of years.
Good, excellent. Does anybody want to take the floor? Good, yeah, thank you. In the front, right over here. Hello? Just there, thank you.
Hi, mic test. Hi, my name is Jerry, and I'm a student here at the LSE. I think the general consensus in the econ community is that there should be an optimal level of inequality. That should be the general direction of the conversation. But do you think it's possible to say that there lies a level of inequality that suits a certain economy, or do you think it's possible, given how countries have changed as compared to the past, that we can turn to history to seek for answers?
Why don't you go ahead?
Do you want to answer that?
Yeah.
You can say more, or do you want to...
Is there another question right away? Okay, good, great. Thank you.
So do you think there's virtue in framing the debate a bit differently, adding other things to this measure of inequality, like maybe mobility, or the ability to consume other things like culture, or so, like just a different measure, or like adding new things? And Peter, if that was the case, would you care more about inequality?
Do we have one more before I turn to our speakers? Great. Now you're warming up. Excellent.
Hello, my name is Iqbal, and I have 2 questions. The first question is about the comment on the fragile labor market. I think it was Mr. Lansley that showed he mentioned about the fragile labor market, and I assume that this relates to job security, and my question would be on job security. So we've seen that over the last 50 years, the trend is that job security is falling and employment levels are rising, and this is because of shorter wage contracts and such devices. So my question is, will the fragile labor market with job security falling, will that affect inequality in the future as job security levels fall even further? And the second question is about income available to invest. So we've seen that the top 1% have gotten a larger share of the income, and the argument made was that it's at the expense of the top 10% of the income. The question is which percentile of of income earners do you think that supplies the largest shares of investment in the economy? Because Mr. Lansley showed that the graph that investment has been falling. So is the top 1% responsible for most of the investments in the economy, or do you think that the bottom, say, 50th percentile is responsible for the investments in the economy? Because I think that's the question of economic growth, and what drives economic growth is which percentile, which income earners in which percentile is driving that investment.
Great, excellent.
Do you want me to start with the last
I'm
one?
ready. Yeah, this is going to be the last round. Is there anybody else? Is there a woman in the audience who wants to ask a question? Great, let's take one, and then we'll hear from our speakers.
Hi, thank you. I realize the debate is concerning a lot about inequality within a country. My question relates to inequality across countries. So what are your views about like a possibility of catching up by the developing countries? Because like we see a lot of increasing investment from the richer countries on the developing countries. So what are your views on that?
Good, thank you. Okay, Stuart, you want to start?
Okay, well, can I just pick up this question about the source of investment? Because I mean, the evidence is absolutely clear that the growth rate ultimately depends upon the quality of infrastructure investment, levels of innovation, and we are very, very bad at this in Britain. We have, very low levels of investment, private and public. Public investment is now down to 1.5%, whereas the OECD says the optimal level of public investment should be 3.5%. Our level of private investment is very low. I mean, as I showed, what's been happening, there's been an increase in we're talking about what drives private investment is the corporate sector. The graph I was showing was basically saying that there's this, there's been an increase in the profit share, but that profit share, that big increase in these pools of wealth, one of the effects of the increased profit share and the bigger fortunes that individuals have has been these great pools of cash and money that are owned by corporations and by individuals. They are greater than they have ever been as a proportion of the global economy. This is not just true in Britain. But in the UK at the moment, 11% of GDP is held in the form of corporate cash balances. That is money that's essentially being taken out of the economy, and it's not being in the past, those cash balances were used to finance investment. They haven't been used to finance investment. They've been used in all sorts of different ways, some of it by share buybacks, that's by buying back shares and unloading some of these cash surpluses. And this has had a significant impact on the point I was making, that inequality creates instability. Because what happened before the crash in 2008, these great pools of cash were used in ways which essentially destabilized the economy. They were used to finance all sorts of financial instruments, mergers and acquisition activity, all sorts of things that helped to destabilize the economy. Since 2008, this money has hardly been spent at all. And Mark Carney calls it dead money. Mark Carney, when he was governor of the Bank of Canada, brought all the corporate sector together in Canada to try to get them to spend this money, but they wouldn't. And that's been one of the main reasons why recovery has been so slow. Labour market, fragility of the labour market is going to, and increasing polarisation is going to be a continuing major problem in the UK, is that we're going to have probably an increase in the number of high-paid, high-tech, high-skill, high-education requiring jobs, but an increase in the number of jobs that require relatively low skills in certain sectors. So we are going to have an increasing polarisation, much of which is going to be generated, this polarisation generated by acceleration in technology. I mean, just quickly, the first point about is there an optimal, I think you were asking, is there an optimal level of inequality? Of course there has to be some level of inequality. There is a certain degree of trade-off between equality and efficiency. If you had a completely equal society, it would grind to a halt. But if you have too high levels of inequality, then it creates different problems for the way the economy works and can be equally destructive. So the question is, what is the balance? My argument is that equality was probably too high in the 50s and 60s, and inequality is too high now. So we need to get somewhere in between. There's been quite a lot of work on what this optimal level is, and it's certainly lower than it is at the moment.
Okay.
I haven't answered all the questions, sorry.
Yeah, no, good, excellent start. Chris, about a minute?
Oh, okay.
Minute and a half?
Yep.
Yep.
Global inequality is brought up here. I mean, yeah, this is very important. We tend to be very parochial about inequality, actually, and forget that we are all in the top 10%, and a huge number of us are in the top 1% globally, and that global inequality has declined enormously. In addition to global poverty, halving in the space of 25 years. These are incredible achievements we should be delighted about. We should hear a lot more about it, I think. But yeah, on a global level, largely thanks to China's development, global inequality is falling. So when we talk about inequality, what is the society of inequality that we're talking about? Are we just talking about London, where inequality is very high, or Britain, where it's a bit lower, or globally, where it's the things are becoming more equal? I don't know, but I think we should certainly. I think we need to have a bit of context about this whole thing, whether it's both poverty or inequality, and try and look at the bigger picture, because we are obviously extremely lucky in this country when it comes to incomes. The sweet spot about inequality, I don't know. I mean, yes, if you believe it matters, then it would be logical to suggest that there is a sweet spot. I don't know if any of you read The Spirit Level, where they show various scatter plots, and things always seem to look better when the gap between rich and poor is lower. Then there isn't a sweet spot there. It's not like it's not a U-shaped curve ever. It implies that the optimum would be zero, which, as Stuart quite rightly says, would actually be horrendous. At the same time, clearly, having one person have everything and everybody else having nothing would be equally horrendous. So I'm not sure that you could scientifically find a sweet spot with it, quite honestly, and I think it would depend, as I've been saying for the last hour, I think it would depend on the reasons behind it, and I think Stuart has given us various examples of things which I think are legitimate concerns, but I think need to be tackled on their own merits, if they need to be tackled at all. And finally, somebody, and this has come up a few times, we're talking about the top 1% getting rich at the expense of other people. Well, let's not fall into this fixed pie fallacy, right? This is it assumes that this money would not exist. It assumes this money would still exist. It would just be in different hands if somebody else hadn't earned it. There is no reason to assume that whatsoever. Wealth is produced by people's hard work and is not grabbed, it is earned, and you can't assume that if somebody else didn't have it, then somebody else would.
Okay. Really terrific. A lot of food for thought. May not be obvious, or maybe you feel strongly about the position that you would take, and now we want to find out what that is. If my colleagues will put up on the screen the link to allow you to vote. So really, what we're looking at now is inequality effectively a red herring, as Chris has argued, or is inequality in fact a central issue, where there's a crucial relationship between what happens at the top and what happens at the bottom. So the question to you is, do we need to worry about future inequality? I'm going to move aside. Okay. I guess you can see it if I'm sitting. Cast your vote. Do we have the findings that come up immediately? Do we know what the results are?
I believe they come on the stage.
Okay, on the screen. Okay. While everyone is voting, it's coming now. I wanted to ask a final question. Okay. Should we worry about the future of inequality?
the yes vote, is it? And there's a no vote coming up, is it?
It's a yes, no question.
Yeah.
See, no.
They'll answer.
One's going to be... Oh, are these different colours?
Do you remember the history of inequality?
Oh, is that neck and neck? Exciting.
We probably have about a minute or so before this is done, and we have to wrap up because we have a great day and a tight schedule. But let's hope we get some results very soon. And in the meantime, maybe a final broad question that just for your general reflections, and that is, what does this focus on inequality, this focus on inequality in particular post-crisis, what does it tell us, if anything, about how we should study and teach economics in universities? Is there a wider set of questions and a wider set of assumptions that could be challenged? Should we expose certain biases that haven't served us well in the past? Should we invite a greater focus on heterodox approaches? What should we be thinking about in the academy when we're learning and studying about economics, if anything, as a result of recent developments?
Stuart. Well, I mean, I come back to, before 2008, even though inequality as measured by the top 1% had been rising pretty substantially, inequality wasn't a political issue particularly, and it wasn't really an economic issue, so it wasn't really taught within universities. You know, the Robert Lucas quote that I gave you, that there's nothing more poisonous than the distribution question. And for the last 30 or 40 years, the distribution question, i.e. the question of factor shares, how you divide the economy between wages and profits on the one hand and between top and bottom on the other, simply wasn't an issue in the economic debate, in macroeconomics or microeconomics. It simply wasn't taught. It was considered to be irrelevant. I think since then, it's risen up the political agenda and has risen up the economic agenda, and because there is growing evidence that actually inequality is an important factor in the way economies work and whether they function well or not, is now back in. It's very interesting that not a single econometric model in the United Kingdom, there's the Treasury model, there's the National Institute of Economic and Social Research model, there's the Oxford Economic, there's quite a lot of models. Not a single one of those models has this issue of the factor share built into it. I actually tried to do some work using the Oxford Economic Model about 4 years ago, in which I built in factor shares, and I just couldn't do it because there was nothing. As soon as you put in increased wages, it led to increased inflation and higher unemployment, and the model effectively crashed. So, in other words, it was designed in such a way that any changes in factor shares would be bad news. Even we know that it's more complicated than that. So it is coming back onto the agenda. I think it should be much more central to our study of macroeconomics and how it works. And I think it is beginning to creep back. But because it would cost such a lot of money, and I've been trying to get some money to do this, there is not yet a model that embraces these issues in our econometric models of the economy.
Great, thank you. Did you have a thought?
Quickly, yeah. I mean, obviously, I think the exact opposite. I don't think it's very important. It should be taught, but only as a fairly minor economic indicator that it is. I think the focus on it over the last 5 or 6 years has been the result of a few things. I think partly this envy within the top 10%, conceivably. I think certainly because of the crash, because people's incomes have been falling, then it's very easy to fall for this confusion between inequality and poverty as if they were one and the same. And yeah, I think fundamentally the discussion about inequality is driven by politics rather than economics, and I think that's partly the result of the fact that the left have sort of lost the battle for production, economic growth, and so they're sort of changing the subject and moving on to something like inequality, where, as I said in my opening remarks, it's actually much easier to deal with. It's not a very good idea to do so because the practical policies for actually reducing inequality tend to have very negative consequences for other parts of the economy.
Okay, the voting is now closed. Are we going to get our results right away? Or should I
Yeah, can we
close?
see the other graph, the one with the bar chart?
Okay, should we worry about the future? Now I have to stand up.
So, pretty close.
Wow,
What's that? Yes.
excellent.
No, we
Okay.
shouldn't.
So I believe no wins.
Take a
Yes.
photo
No,
of
we
that.
shouldn't win, but it's a close one. Okay, I have to say I'm a little bit surprised at the results. But, well, it says something about the quality of our speakers, but it says some other things, too, that we might have to reflect on after this session. We're running a bit late. I have to close this down, but please join me in thanking our speakers, Chris Snowdon and Stuart.